37%. That is the highest tax rate on the money you sweat for, while the person owning the company pays 0 to 20. You are being penalized for the crime of working for a living. I'm Alex. This is Wealthonomics, where we expose the financial mechanisms the wealthy use to stay ahead while the rest of the world falls behind. Last week, we exposed how the hidden architecture of wealth protects the elite. Today, we look at why the very ladder you're climbing is designed to snap. We're going to dismantle the middle-class trap and show you the exit strategy. In 1943, the US government passed the Current Tax Payment Act. Before this, people paid their taxes once a year. After this, the government took their cut before you even saw your paycheck. It was a temporary wartime measure that became the permanent leash of the middle class. This mechanism was designed to ensure the state had constant liquidity, but it did something far more sinister. It removed your ability to use that capital for yourself during the year. You became a non-interest-bearing lender to the IRS, while your costs of living continued to skyrocket. By the time you realize the game is rigged, you've already lost 30 years of compounding. Your local bank isn't your friend. It's a sophisticated extraction engine. Think about the 30-year mortgage. For the first decade, your payments go almost entirely toward interest. You aren't building equity. You're paying for the bank's next skyscraper. The system encourages you to buy assets that are actually liabilities, like high-interest car loans and primary residences that eat cash every month. But here's what your financial advisor will never tell you. The retirement they sold you is a mathematical impossibility in an era of 7% real inflation. They want you focused on the 401k because it keeps your capital locked away, stagnant, and taxable at the highest possible rates later. The part they deliberately don't teach in school is that the tax code is written in two languages. There is the language of income, which is a trap for the ambitious, and the language of assets, which is a playground for the elite. If your wealth is tied to a W-2, you are a source of revenue for the state, not a builder of legacy. Here's the thing that keeps middle-class families trapped generation after generation. They are taught to save money, a depreciating paper currency, instead of acquiring the mechanisms of production that the wealthy use to hedge against the very inflation that destroys your savings account. Everything I just told you is accurate, but there's a dimension to this story that almost no financial content creator covers: the velocity of capital. The middle class is taught to park money and wait. The wealthy are taught to move money and multiply. If your dollar sits still for more than 24 hours, it is losing value. The trap isn't just about high taxes. It's about the liquidity freeze, the systemic pressure to keep your net worth tied up in things you can't actually use when a real opportunity appears. This is why the rich get richer during crashes, while you just watch your portfolio bleed. To break the trap, you must understand the qualified dividend and long-term capital gains gap. While you pay ordinary income tax on every dollar over a certain threshold, the elite are paying a fraction of that by moving their earnings into specific asset classes. This isn't just unfair, it's a design feature. They use tools like the Section 179 deduction to write off luxury equipment and vehicles, effectively getting the government to subsidize their lifestyle, while you're stuck paying full price for a sedan that loses 20% of its value the moment you drive it off the lot. Let's talk about the Golden Handcuffs, corporate benefits, the healthcare, the matching, the stability, are designed to make the risk of leaving the system feel life-threatening. The system doesn't want you to be an entrepreneur. It wants you to be a highly efficient, high-taxed unit of production. Here is the pattern interrupt. The most expensive thing you will ever own is your career if it prevents you from building a business. The tax code for a business owner has over 5,000 pages of incentives. Read loopholes. The tax code for an employee is essentially a one-page bill. You are subsidizing the very people who are outbidding you for real estate. You need to stop saving and start allocating. Your first step is moving from the income bucket to the asset bucket. This means looking at things like health savings accounts, HSAs, not as healthcare funds, but as stealth IRAs. It means understanding cost segregation in real estate to front-load your tax benefits. It means realizing that a $100,000 salary in a high-tax state is often worth less than a $60,000 business income after deductions. This isn't just about math, it's about your sovereignty. Every year you stay in the trap, you are trading your life force for a currency that is being printed into oblivion. The stakes are your freedom. If you don't change how you interface with the financial system, you will wake up at 65 with $1 million that only buys $100,000 worth of today's goods. That isn't a retirement. It's a slow-motion catastrophe. You have the intellect to see the cage. Now, you need the courage to pick the lock. 3 things to take from today. First, the W-2 is the most heavily taxed financial instrument in existence. Second, your primary residence is a bank asset, not yours until the interest is paid. Third, true wealth is found in the asset side of the tax code, not the income side. Remember that 37% tax rate? Here's what that actually means. The government owns over 1/3 of your life's work, unless you change the game. Next on Wealthonomics, why your salary is designed to keep you dependent. If this changed how you see the system, subscribe. The next one goes deeper.